Hi, everybody. Mitch, Kramer, and Trey, Talley welcoming you to the Fluent Financial August webinar 2025. Hopefully everybody had a good summer in Texas. We had a great summer. I think only 5 days it got over 100 and expecting kind of a cool weekend. This webinar will be significantly shorter than the one we had last month. We had a lot of information to cover. Obviously, we spent some time going over the big, beautiful bill that was passed and the implications for that. So joining me on the call is Trey, and we'll go ahead and get started. So Trey, I'll start with this slide. The information provided here is Fluent Financial, it's my opinion, and Trey's, not private client services. With that, I'll turn this over to Trey.
Thanks, Mitch. Hello, everybody. So speaking here in August, last time we spoke in July, we had just come off of a Fed meeting where the central bankers really threw some cold water on whether we're going to get some rate cuts and how many this year. But we've gotten an inflation report that was kind of ugly since then, and we've gotten a jobs report that was even uglier. And through the Jackson Hole meeting that Jay Powell gave last week, he really reaffirmed that the Fed does need to cut rates this year, and they're probably going to do two starting in September. In terms of markets, we've really just kind of seen a steady melt up there as the reversal from Trump's tariffs in mid-April took effect. The markets found their footing and really just haven't turned back. We have not really seen any material pullback, 5% or more since then. And so the markets are kind of back up towards lofty valuation levels. Jobs market is weakening. Inflation is a big question mark. We are starting to see some throughput from tariffs that are starting to impact prices. And so there's a lot of uncertainty here. This webinar will be kind of short because luckily there hasn't been a whole lot that's changed since last month, but that might change by September. But with that, we'll go ahead and kind of dive in with the next chart here, which is the leading economic index. We start by looking at the contrast between it and the white line and the S&P 500 there and the gold line. So this index, it often weakens before recessions and improves before before the expansion of the economy. And they tend to coincide in terms of the index in the market. And so as the leading economic data has been quite weak, it kind of gives us some sort of gauge of the risk level that is out there in the market, and we can kind of adjust portfolios to be more defensive in light of that. And so the picture here is markets are kind of ignoring some of that right now. There's a good AI bubble going on there, and that seems to be ruling the narrative. And one day that will come to an end. For the time being, when we look out the windshield, we'd like to see more optimistic data than is currently present with these indicators. So that's again that kind of the story that's been told all year. We'll go kind of to the next slide here, and we'll kind of look at what's going on in markets. Left side is a number of different indices, and right side is our portfolios there. So the story this year has really been generally a pretty strong year. Obviously, we had some volatility in the first and second quarter of the year, but most of the returns have come from overseas markets. International developed and emerging markets have done quite well, about double the returns that we've seen here in the U.S. So the NASDAQ up 12%, but emerging markets up over 20% during that time period. Bond yields are down on the year, so bonds are kind of appreciating here or participating in some of this rally this year, which is nice. Over the past month, we have seen a breadth pickup, which means the market concentration has generally been contained to these AI names, but over the past month, we've seen some of the laggards start to play catch up. So the equal weight, the Dow, the small caps, they've all kind of joined the party. And that's a good, healthy sign for the market. We want to see broad participation. That's certainly what we've seen over the past 4 to 5 weeks. Portfolios are doing great. Most of the passive models are keeping in exactly where we need them to be. The covered call models have been able to slice and dice through all of the volatility really well this year. And then VNO is kind of our active managed portfolio, up over 17%. So a lot of that's come from some of those overseas markets. It's come from good timing decisions in the first and second quarter of this year. So we're really proud of the strong returns there in VNO, and we look to close out the year just as strong. So with that, we'll go kind of to the next slide here. We talked a little bit about in the introduction about what the Fed is doing here. So Right now, we're sitting at an interest rate of about 4.5%. And the Federal Reserve has pretty much all but guaranteed a rate cut here come September. So we're looking at an 87% chance that we get our first rate cut of the year, which will take us down to about 4.25%. We're going to get 2 cuts this year, and we'll get about 5 to 6. It's kind of splitting that line, but 5 to 6 cuts between now and December of next year, which should take us into the low 3s, maybe 3% overnight rate there over the next 15 months or so.
And Trey, I think one thing that's important is this is if we have no recession. And the odds of a recession from the betting markets, poly markets specifically, less than 10% chance of a recession in 25. 26, we don't know. Historically, when the Fed's cut rates, 2 of the last 3 recessions, they've cut rates to 0. And right now we're about 4.38 to 4.5. So if rates get cut significantly, those of you that are holding bonds are going to see nice appreciation. I know a lot of people have been impatient saying when are rates going to go down? And we're going to talk a little bit more about that here in just a minute, because we have a tug of war going on between higher inflation potential because of tariffs. We also have a very weak employment market that's getting weaker and weaker. And I think you're going to see the Fed finally acquiesce to the labor market and start cutting rates. Right, this next slide, I think, does a good job of explaining the inflation issue, and we start to see some tariffs pick up here.
Yes, exactly. So the chart we're looking at here is inflation. It's the headline in core inflation being that blue line, headline being the white line. And so we've got overall year-over-year inflation of about 2.7%, which is pretty mild, but it is above the Fed's target of 2%. Core inflation, some of those stickier elements hanging out just above 3% there. In the bottom there, you can kind of see the purple bars that we've got that circled. That's your goods inflation, your core goods inflation. So if tariffs are really to bite in terms of prices, they're probably going to do it through goods. We haven't had a lot of services targeted tariffs right now. And so what we are seeing is a pickup in some of those prices. It's kind of modest at this point. About 0.25% of the overall inflation can be attributed to that. And so it's not anything to the absolute levels that we did see in 21 and 22 coming out of COVID, but it is starting to pick up. And core goods, through the balance of last year it was helping to weigh down inflation. It was bringing prices back to normal, and we've kind of lost that help as tariffs are coming through and pushing up prices. This is a report that came shortly after the last Fed meeting, and we'll get another one before the next Fed meeting. But this one really kind of shocked markets. This one was a little hotter than expected. Initially, the Fed kind of came out in some of their speeches that they do inter-period and really doused a lot of cold water on the rate cut narrative. So this got them re-engaged in some of the fears around the prices. We'll talk about employment in just a second, but that one was kind of a scare in the other way, in which they said, you know what, we need to speed up on these rate cuts to save this economy, or we're going to be too late.
The next slide, when you look at tariffs, I think this is really interesting. This is where you can see the amount of income coming into the market.
Yeah, exactly. So this is just a tariff tracker. And what it's doing is just looking at the Treasury website and calculating up how much money are we collecting from these tariffs. So since Liberation Day on April 2nd, we've collected just over $128 billion from tariffs that get remitted to the Treasury, which kind of helps reduce some of the deficit. Those monies are paid by manufacturers, consumers, exporters, wholesalers alike. So it is a pickup in prices that we are paying for. But overall, how does this contrast to last year? We did have tariffs effective last year in 2024, pre-Trump, and they amounted to almost $83 billion through the full year of last year. So we are, seeing quite a pickup in the tariff collections at $128 billion. I think the Trump administration is targeting somewhere around $300 billion annualized. And we're still below that target there. The effective tariff rate for the U.S. is just below 9%. There's a lot of exemptions that are currently on, a lot of pauses, things like that are throttling that a little bit. So overall, that's kind of the pulse on tariffs and what's going on there.
Next slide, Trey. Yeah, the next slide, Trey, I think is really interesting because some of the tariff income is helping reduce our deficit, and the trajectory on this next slide looks very interesting because you can see the debt on the right-hand side here as a percentage of GDP. And on the left-hand side, you have interest payments and the primary balance. And the orange area is interest payments. And as interest rates are relatively high compared to historic measures, that's a big part of our government debt. That's why Trump's being so hard on Powell, trying to get them to cut rates. And if we can get them to cut rates, our government is spending less money. And you can see the white area here shows the percentage of GDP gets more in the comfortable range of 2 to 3%. So, Trey, what would you add to that?
Yeah, exactly. I think it's really important that the deficits that the government can control, their spending have been coming down since 2022, and we're the optics are that we're going to continue to make headway on that. So that'd be those white bars that you see. A lot of what we're paying right now is interest payments. Interest rates have been high for the past several years, and we have a lot of debt. So the servicing cost of that has grown quite a bit. But as the Fed lowers rates, so does the service cost there. And so right now we're running deficits of GDP around 6%. That's quite high. 6 to 7% starts to get the market a little worried. Yields kind of bump up there to push in a risk premium. Something for an old developed market like the US, a lot of our G7 components, probably looking at somewhere around 3 to 4% deficits of GDP. Most mature economies run deficits. That's not surprising. So we're a little higher than we need to be, but if rates go lower, and so do the servicing costs, the deficits are going to shrink pretty quickly. Trump surely knows that. That's why he's out there pushing for lower rates there, and he knows what how slow the economy is going to be with tariffs. But this is good news. I think there's a lot of headlines that drive a lot of hysteria, but the truth is we are actually becoming more lean in terms of our deficit. And once interest rates go down, the picture is going to look pretty good pretty quickly. So that's really the glass half full.
Yeah. Next slide, I think, is what concerns me the most. And you hinted at this at the beginning of our webinar, the employment picture.
Right. So we talked about that inflation report. That got the Fed scared that inflation was going to, reaccelerate, and that rate cuts maybe is not what they needed to do. It was only a few days later that we got the jobs report that showed them that they needed to be scared, that the economy is really coming to a halt quite quickly, and the jobs growth is very weak, and that they do need to do these rate cuts if they want to stave off a recession. So this chart here, the gray bars are the month over month payrolls reports. How many jobs do we create over the month? Last month was 73,000, but we got a lot of revisions going back to about April. And so what we've seen is since these tariffs were announced, really there has been not much hiring at all. Over the past 3 months, we've only averaged 35,000 jobs through the entire country. And just to contrast that, I mean, we were, 150 to 175,000 average last year. Through 22 and 23, we were, 300 to 500,000 a month. So we have, effectively stalled job creation in the country here. There's a lot of uncertainty. Tariffs are slowing things down, and we're getting a lot of net migration out of the country, which is slowing some job growth as well. At 35,000 jobs created on average a month, this had the Fed very worried. This low of employment will raise the unemployment rate. The Fed is very worried about that. And it was only, it was essentially that same day they came back out and said, we're going to go in September. We're going to start cutting rates. We need to get ahead of this thing because the train is slowing very quickly here. And so that's kind of, that's something we flagged for several months now. Jobs are slowing. That is definitely the case now. We'll get another employment report next month and, next month and next week. And if it's this bad again, we may start hearing talks of 50 basis point cuts each time by the Fed, or maybe an emergency cut. Things have really slowed down really quickly. It caught a lot of investors off guard.
Yeah. I think what's important is Trump got so upset with the BLS chairperson, he fired her because he got tired of these numbers being restated. Now, whether it was justified or not, who knows? But the last 2 years, we've seen revisions to the downside. You look at this orange line, which is a 3-month moving average, it's decreasing. So this actually could go negative next month. we'll see it. So this next slide, Trey, talks about higher unemployment, I should say. So I think the white line is very interesting.
Yes, here. So this comes from the Conference Board. It's a survey. They're surveying consumers, and they're asking them two questions. And they're asking, if you're searching for a job, is it easy to get a job? And if you're searching for a job, is it difficult to get a job? They kind of create a little spread here. What it does is it acts kind of as a leading indicator of what unemployment rate will do. And what we've seen over the past several months, and even this month as well, is we've seen this metric continue to deteriorate. The job market's slowing really quickly. And what this does is it tells us that the unemployment rate, while it has been hanging around at about 4.2%, all the indications are that the unemployment rate is about to start moving higher and pretty quickly. With that low level of job growth and a number of other leading indicators of employment here, we're about to set a new high in unemployment rate. That's why the Fed is worried. That's why they are getting ready to do rate cuts. And if the unemployment rate starts to really move up really quickly, we're going to get more and more cuts, and rates are going to go lower and lower as they try to avoid a recession.
And again, that's a benefit for those of you that have bonds if rates go down. Trey, I think what's really significant here is this white line is the leading indicator. The orange line will follow it. And if you look at it, we're at levels back in the 2015-19 area and almost to the areas where we were prior to the Great Recession in 08 and 09. So this is very ominous. Now, this next slide talks a little bit about Trump's America First, and it basically shows this flat U.S. born, and then the immigrants that have come in, it's going down pretty precipitously.
Yes, we're just looking at the period, the beginning of 2020. So the post-COVID here, where's the job growth been? And it splits it out between foreign-born and native-born workers, with the foreign-born being that white line and the native-born being that gold line. And so it's in percentage growth terms. So you can see that, kind of coming into office for Trump, kind of at the right side of the chart there, most of the jobs that we've created over the past 5 years, almost exclusively, have been they've gone to foreign-born workers. About 20% of the growth there from 2020 levels, while the native-born workers here, the actual Americans, they essentially had no job growth in almost 5 years. We've seen kind of that flip the other way and start reverting. And so what we've seen, I've got that dashed line there that shows the first employment report after Trump's inauguration. What you've seen is the foreign-born population growth or the job growth really started to head the other way, just now at just 13.5%. And so as the foreign-born workers have started to move out of the labor supply, that's creating an appetite for domestic workers here to help fill in some of that labor demand. And so this is what Trump wanted. He wanted more jobs for Americans and less for companies trying to exploit foreign labor. It is no doubt feeding into the weak job growth that we are having as well. I thought this was an interesting metric that we came across, and it shows kind of what the administration is trying to do and its effectiveness.
Very interesting. The next slide is the second area of concern when we put this together, and it has to do with student loan delinquency. And Trey, I got some data I'll share with the group after you kind of go through and explain what people are looking at.
Yep. So over the past several months, students who have student loans have been required to start paying them back. And so now you're required to pay them back. If you do not, you will be reported to the credit agencies. And so as we started getting the reports back, because they've effectively been null for the past several years, we got to see the first look at what the delinquency rates for these student loans are. And it kind of breaks it out there by age, all the way from 18 to 29, on the high end, the 50 plus cohort. So most of the cohorts are back at kind of pre-COVID levels. We did see a big spike up in student loan delinquencies. I think this is important because they're 90-day delinquencies, what we refer to as serious delinquencies. So these are not people that their debit card expired and they forgot to, replace the new one. These are people that have been 3 months or more late. These are people that are in financial distress and cannot pay. And I think what stands out to me the most is the 50 plus cohort, where, almost 1 in 5 student loan debt holders, that are above 50 years old are delinquent right now, seriously delinquent on their student loans. They're the only cohort that's materially above their pre-COVID levels. And I don't have a great reason for this,
Yeah.
honestly.
And,
I'm perplexed.
yeah, Trey, I did some research on this because I was perplexed as well. It's coming from multiple areas. And one of the areas it's coming from, a lot of the parents have co-signed or signed for their kids to go to college. And the kids are having a hard time finding a job. And the parents are having a hard time paying their bills, including student loans. And another factor is a lot of people were going back to school to retrain and develop some better skills. But what they're finding is because they're older, their hireability is not as great. And since they can't find a job, they're not going to pay their student loans. So they got to pay food, clothing, and shelter. So it's a combination of those two factors that explains why the 50-somethings are struggling. And then the other part of it is as they get closer to retirement, they just don't have the income to pay their bills. So this is a very alarming trend that we see happening. This decision by the prior administration to waive payments for basically 4 years was egregious. And I think maybe a lot of people built lifestyle on the money they got out of the COVID stimulus, and they didn't budget that they'd have to pay for these loans. And the other part of this is interest was building, and now people are having to pay principal and significantly higher interest payments because these loans have been deferred for so long. So that has a lot to do for this. This is something we're paying attention to. In prior webinars, we've shown delinquencies for cars and mortgages. This one we just highlighted for student loans. I suspect we'll show more in other areas going forward. So the next slide has to do with the crisis in jobs and the lack of jobs for younger people getting out of college.
Yeah, so here's just the underemployment rate for young adults. There are young working adults who have a job, but maybe they have a a 4-year degree, but they only have a job right now that requires a high school education. And so what we see is almost 18% of all young working adults are underemployed right now. That usually starts to kind of turn up as the economy softens. One of the largest responses that they got was that the job market is very slow and the appetite to hire is very low. But also companies are increasingly looking towards artificial intelligence to try to fill some of the roles. And so these young kids are trying to compete against a weak job market and AI that's kind of come in and taking over some of those menial jobs. And what it's leading to is just more and more young working adults just not quite earning what they should be. And so, this is going to have a profound impact on, these young people's lives and the wealth creation that they have and who they vote for and all kinds of things here. But just another metric, when we look at the job market, just continues to show its weakness.
Yeah, I think many people on this call, they can relate to this either personally or people they know, their family. A great example of AI replacing a lot of high-paying jobs. Think if you were a computer coder, you've been doing that 20, 25 years, well, AI just replaced you. You got to go back to school and retool and get some new skills. Or if you are a lawyer, and historically lawyers will do research, the junior and young associates, well, you pay them a good 6-figure income and they're going to work, maybe 50, 60 hours a week. You can hire an AI person, do research. It's going to run 24/7. You pay them a fraction of that. So those are a couple examples of what we see with AI. So it's something to pay attention to. Last slide we'll finish with is our option slide. And these are our 3 heavy option portfolios. And Trey and his team have done a good job of producing a good yield from these portfolios. This is not rate of return. This is yield from the portfolio. So these are the amounts that we target. This is what we've done trailing 12 months. So they're still doing a good job with that. So as I wrap up and finish, we'll open this up for Q&A. So this one was about 24 minutes. It was less than half the one from last month. So I'll go ahead and stop the recording and we can answer any questions that you may have.